Right, good morning, everybody, and welcome to this week's episode of Trending Treasury, Arlene Close's weekly webcast. So this week I'm joined by my colleague Nick Keeling, and we will be talking about investing in housing associations. So Nick has led on facilitating a number of housing association investment transactions, and he maintains close contact with our contacts within the sector. So a little bit of housekeeping before we start. Please make sure your cameras are off, microphones are switched off as well, and of course your speakers are on. And there is a chat box on the side, so we'll be happy to pick up any questions as we go along or towards the end. So we'll kick things off. Hi, Nick.
Hi, Amar. You okay?
Good, thank you. How are you doing?
Yeah, I'm okay, thank you. Yet another week in lockdown, but the end is
Well, I
near.
thought this one would be a happier one since the schools have reopened and your kids are back.
It's a little bit quieter, and yes, I can get a lot more done. But even so, in general, it hasn't really changed that much. But still, it's not too long now.
Good, good. So I thought we'd kick things off, Nick, with maybe if you could give us a brief intro into what a housing association actually is, what they do, and maybe focus on some of the regulatory background as well.
Yeah, it's a good place to start, I guess. I doubt I'll be saying anything that people on the call don't already know, given that most of our clients are local authorities and so probably have some involvement or have had some involvement with the house associations in the past. But anyway, it's a good starting point. So housing associations, so registered providers in England, they've all got different names depending on which region they're in. Registered providers in England, registered social landlords in Wales, housing associations in Scotland, registered social housing associations in Northern Ireland. They're generally not-for-profit organisations, although there are some for-profit. Actually, it's a slightly growing sector within the area, but mainly not-for-profit, and in general, they just provide social and affordable housing to those that need it. And by social and affordable housing, I mean housing that's available below market levels. So below market rents. So it's available to those on lower incomes, for instance, or with certain needs. So the elderly or disabled or those kind of issues. Actually, that brings me on. So some housing associations focus on certain sectors as well. So most housing associations will have just general needs social housing that's available to anyone that meets the criteria. But some will focus on, for instance, supported housing. So they'll provide supported housing, which is social housing, but with certain supports attached to that. For the elderly, for instance, or like I said, for the disabled or very low income, or just those that need a safe refuge. So you do get different types of housing associations. They're all not similar in that regard. How do they work? Well, obviously, that they are a property company essentially. It's just that they're renting housing to a certain sector of society. So they receive rents for running from their tenants, and they use the rents to run the housing association, to upkeep the properties, for instance, and actually pays interest on debt, of course. So assuming that they've got enough room in the difference between their income and their expenditure, they can borrow to actually develop more housing, which is actually one of the things we're going to talk about today. In terms of, I've kind of given a very simplistic view of what a housing association does there. Some housing associations are very complex. Lots of housing associations will be groups of companies. So there may be a main housing association within that group, but there will also be subsidiaries, either to the group company or the housing association itself, which could provide, I mean, their maintenance might be a separate company, for instance, the maintenance of the actual properties, or they might provide social services, not those social services, but social services to their tenants. So it could be helping them with financial, giving them financial assistance, or in many cases offering some kind of training or apprenticeships or something like that, so job opportunities. So they're not just focused on the housing, it's also for the betterment of tenants and the wider community. More commonly, housing associations have development companies. So a development company that develops social housing, but also develops other types of housing. So it could be market sale, it could be shared ownership. So very much more as time's gone on, housing associations have moved away, not away, but have supplemented their main social housing business with the development of more housing in different areas. And then they use the revenues from that to subsidise the social housing business. I think you asked about regulation, didn't you? Yeah. Okay. So on regulation, so housing associations are regulated by the governments, the devolved governments. So the UK government in England, obviously, and the various devolved governments. They've all got different kinds of names. So, for instance, in England, it's the Regulator of Social Housing, which is the department or the body that regulates that sector. Regulation essentially focuses on two areas. It focuses on essentially tenant welfare, so tenants treated fairly and well, and they get value for their money, I guess. But also it focuses on whether they're financially viable as well. So generally, consumer standards and economic standards is what they call, divided that up. And it's fair to say the regulator has a number of powers. It can intervene in a limited way in these organisations, but it's also fair to say they've been watered down a little bit. So if you cast your mind back to when we were very focused on the deficit, the ONS recategorised housing association as public sector entities, so all their assets and debt came on the balance sheet, which was clearly, when we're trying to get rid of debt, the UK government's trying to get rid of debt, that was a no-go. So they made certain changes so those could be reclassified back into the private sector. Okay, so it's fair to say that some regulation, some public sector involvement, like local authority involvement, has been watered down a bit, but there's still very effective monitoring process, oversight process from the various regulators, and intervention where necessary. And of course, we like that. You know, any investors, any lenders, it's certainly a benefit there that you've got a separate party, an independent party, looking over it and keeping everyone on the straight and narrow. So on housing policy, I guess, which is the last point you pointed out, the UK government is actually very supportive, or appears to be very supportive, of building new housing, so increasing the housing availability in the UK, and it certainly sees housing associations as part of that solution. So whereas when we were in austerity, if you remember, some of our listeners might say we're still in austerity, from a local authority perspective, but the coalition government, the previous Conservative governments did impose austerity on housing associations as well, but more recently we've moved away from that and are actually seeing housing associations as part of the solution, particularly to social housing, but also development of new houses. So that there is a focus on that from UK government, which of course is great for the sector.
Thank you. That was an interesting introduction to everything. And then maybe talking a little bit more around what sort of funding requirements or arrangements do the housing associations tend to look for, and what sort of investor appetite is it? Who tends to be the people, lending the money to the housing associations?
Yeah, good question actually. So types of lending. So what are housing associations? They are essentially property companies, really, the social housing that they provide and need to develop. So these are long-term assets. So it's no surprise really that much of their borrowing that they undertake is long-term borrowing. So we could be talking 25, 30 years, quite long terms. How will they access that? Well, generally they'll approach, perhaps not, I'll talk about the banking sector later, but they'll approach investors that are comfortable investing at the long end, so need long-term assets, and they will use the property that they've already got available to secure that lending. So that could be through a private placement with a pension fund or a life insurance company, something like that, or it could be actually issuing public bonds into capital markets, and a wide range of investors, but similar investors will buy that. So pension funds, and if you look at pension funds, I'm pretty sure most of them will have a portfolio of longer term housing association bonds. In terms of kind of more day to day or medium term needs, so lots of public sector, lots of local authority clients on the call. Housing associations don't have access to the PWLB, for instance, nor do they have access really to kind of the LA market. The very liquid market. Local authorities are very receive huge benefits from those two kind of markets, if you like. So housing associations will set up liquidity facilities with shorter term investors. Now, due to the change in banking regulations is where the banks come in. Banks used to be long-term lenders to the sector, but the changes in banking regulations we've had over the last 10, 15 years or so has really moved them down the curve. So generally they're looking at between 5, 7 years, maybe 10 at the outside in general terms. So they're not there for the long term, but they're there for the medium term. So they will offer facilities such as revolving credit facilities or other liquidity facilities to housing associations, and it's a necessity. They need day-to-day cash, and they do draw on those facilities. And the regulatory bodies also want to see the fact that they do have liquidity available in case cash levels decrease. So it's to them that they manage their cash at a short-term basis in a very similar way to our local authority clients. It's just that they don't have the ease, so they need to set that up. In terms of investor appetite, there's plenty of investor appetite actually. Local housing associations borrow relatively narrow spreads for long-term debt, and relatively narrow spreads for short-term their short-term facilities too. One, the long-term tends to be secured, which obviously brings down the credit risk, but clearly the regulatory oversight, high levels of transparency because of that, and the focus on housing, fixed assets, does mean they can borrow at quite low levels, which is indicative of a high level of investor appetite.
Yeah, and I guess that quite nicely takes us on to, you mentioned, the need for the short-term funding, and of course our client base are local authorities, and we're focusing on treasury. So how can local authorities get involved in lending to housing associations?
Yeah, so again, some of the listeners today might have personal involvement in some of these arrangements. So housing associations are generally, like I said, they need short-term liquidity and medium-term liquidity for working capital needs, but they also need long-term funding for their development. So from a local authority perspective, housing associations tend to be partners in the local area. So the housing association is focused on housing delivery, but also on other areas as well, as social areas. So actually, the local authority might find that the housing association is helping it meet its corporate objectives in many areas. So it's not unusual to find that the local authority will use the housing association's delivery company. So it may lend long term for a certain project to the housing association, and given it's a long term loan. More work needs to be done there on structuring and due diligence, and the type of rates that are available as well. We've had state aid issues where you have to lend at broadly what the market's lending on the same terms. So that's really important. You can't really subsidise the housing association, but you can make it available and work in partnership with them, which might be a better way forward for the housing association itself. Obviously, we've been involved in those at Ireland Close. Given the terms on these kind of arrangements, these local capital delivery, if you like, it tends to be long-term loans that are being made, 10, 20 years plus, something like that. So a lot of work needs to go into kind of the due diligence arrangements, the monitoring arrangements, the structuring of the loan, like I said, and the type of rates that are necessary. And we do help our clients with that. Now, on the other side, there are other partnership arrangements which kind of ape those kind of long-term issues. But on the other side, we also get involved in the lending for treasury purposes. So a local authority would see it as making a short-term loan as an investment, as a diversification tool, or as an income-generating tool. The housing association would see that as a working capital funding, well, no matter what it is, where it'll fit inside their short-term funding needs. So this doesn't mean that just because it's short-term doesn't mean that you shouldn't be doing your due diligence on it. You definitely should be doing due diligence on it. Housing associations are, I think in the intro I said about how complex they can be depending on the housing association. So they're not all the same, much as we say local authorities aren't all the same. Housing associations, the degree of variability given the different sectors they look at, the different business plans, different historical decisions, can be very different, in fact, and very different in terms of credit worthiness. So while investor perception is generally good of the sector, and I think our perception of the sector is generally good, there is the range of the good and the bad, if you like, or the weaker and the stronger, and due diligence is definitely necessary to pick those out, particularly for a treasury investment where you're doing it very much. It's not partly policy. You're doing this for security first type of issues. So you really need to be set on that. So due diligence is incredibly important for that, or maybe less so on the structuring side. Now we actually get involved more on the short-term side to some extent. While we might work with one local authority on the longer term side in terms of that project. On the short term side, we do facilitate short and medium term investments with housing associations, and we'll take on board all the due diligence. Well, I can talk about that if you like. Is that something?
Yeah, that would nicely lead on to, it'd be interesting to know about what Arling Close's involvement is in advising our local authority clients in the whole arrangement. So you've spoken a lot about the due diligence. So is that something that's provided to clients?
Yeah, this is also useful for their own, if you decide to do something themselves on a bilateral basis. So, excuse me, Arling Close. As you know, Arling Close essentially sources solutions to the various things we raise as opportunities, and so we needed to, while we can sit here and say our RPs, housing associations, are good to look at and a potentially good investment, we also decided we need to go out and actually find something that we could present to our clients as an object, as a solution as well. So on Enclose, we're quite active in talking to potential borrowers, talking about their needs. So by borrowers, so here we could obviously mean housing associations, talking about their needs. What are they looking for? And then seeing if we can match their needs to our investors' needs, our clients' needs, our local authority needs, and having a midpoint there that both sides will be happy with. And that could be in the structure, it could be on the rates. So the needs of both are slightly different, but then there's generally a midpoint we can get to which meets both. Assuming that's something that the borrower wants to look at, we then will then take that borrower, that housing association, and do some quite involved due diligence on it. So the credit team will take that away. They will do due diligence on now associating in terms of kind of the local economic conditions or the general economic conditions. What's the regulatory environment looking like? And government policy. So I covered those in the intro, but actually they change quite regularly, and they have changed quite regularly over the last 10 years. So knowing how the regulators viewing housing associations and knowing how its involvement has changed over time is an integral part of our due diligence. Obviously, then you've got to look at the housing association as an individual association. So you're looking at its historical performance. We're also using business plans to look forward and say, well, what are you planning to do? Where do you expect to use this money? How do you expect to pay it back? What's your interest cover? Can you afford the interest on it? Can you afford your interest already? And how does that compare to other housing associations? So it's not it's not a kind of historical look. It's really looking forward as well. You want to know how, what their contingency arrangements are in case of, what's their sensitivity analysis looking like? What are their business plans if, I don't know, if Brexit hadn't been concluded, for instance. We looked at some associations and they had contingency arrangements and economic outlooks that changed their business plan if Brexit hadn't been resolved in the way it was. And also pandemic issues, of course, are a massive issue. So when we do due diligence on housing associations now, we need to know, how have you handled the pandemic? How do you expect it to change your business, and what do you expect to do about that? So these are incredibly important whenever you do due diligence on any organisation anyway, but especially housing associations. So, we need to be aware of the risks. At the end of due diligence, the credit team comes back and says, well, we will recommend or we won't recommend an investment. And if they are willing to recommend to clients, then they will generally give a time limit which we're comfortable with as a house recommending this investment to clients. So we do that with all our banks as well, of course. So clients are used to that. And so we do that, and then it's about going back to the borrower and saying, well, this is what the due diligence has thrown up. So this is what we can do for you in terms of, it might meet their objectives, it might not. We might have to negotiate a bit more. This is where we think the appropriate rate will be because of your credit risk. So obviously that builds into the rate as well. Assuming they're happy with that, then we can go out and source lenders to meet their requirements. So their requirement will be, I don't know, we want 20 million of local authority funding, or 40 million or something. So we find lenders to meet that need, obviously tackle any issues that are raised by the lenders as well in terms of our due diligence and in terms of our recommendation. But then we proceed through to execution. So part of our due diligence is based on the fact that we do employ a solicitor on our investors' behalf. He works on, their clients are the local authorities, and it is covered by a full investor agreement, a loan agreement. So we want our clients to have exactly the same protections as all the others investors. We don't want them going in and being a lesser investor, if you like. So we make sure everything's on the straight and narrow, and a lot of our due diligence is based on the fact that we are going to have that agreement sitting behind it. And then, of course, it goes through to execution and we get it sorted.
So you mentioned, essentially it's a pooled arrangement. So are those agreements per client? Are they bilateral agreements?
Yeah, they are actually. Yeah, so it's not a group agreement, but the agreements will all be the same.
Yes.
Okay, so for a housing association, they go to a bank and they can get a 50 million facility, for instance, from one lender. So what they don't want to do is have to do a group arrangement with lots of bilateral arrangements, but have different terms for each one, because that doesn't really work for them. So we get around that by having the same agreement for each, and it works. Obviously local authorities take it to their teams, their legal teams, to have a look at it and make sure they're happy with it. And in general, they'll come back with no issues, and we'll go forward with the investment.
And have you seen any trends in terms of investment structures that the housing associations tend to prefer?
Yeah, I think I mentioned, housing associations will look at things that meet their needs, and they have a need for liquidity, essentially. So the liquidity, like local authorities, when local authorities, but it's almost the same. Do local authorities borrow an hour later when they've got cash? And it might be a great time to borrow now, but actually we've got loads of cash, so all we're doing is building our cash balance. And housing associations are in a similar space to some extent, except they've got a bit more flexibility. Perhaps they might have cash now, but they can still set in place an arrangement to cover expected liquidity, for instance, later. So this is what the RCFs do. This is what revolving credit facilities do. It sets up with any lender an amount of cash, or amount of funding which is accessible by the housing association, by the borrower, through the term of that facility, and they can borrow and then repay at various points throughout. So it's not a bank account, obviously, but it gives you that type of flexibility to borrow and repay, which is great, because it means when you've got too much cash you don't need to borrow, but when you need a bit of cash you can borrow and then repay when your cash levels improve. So that's what they need, and that's what we're seeing as well, as part of our arrangements. We're seeing a move towards RCFs. Regulators like to see them as well, so clearly it sits well with them. It meets regulatory liquidity requirements as well. So, but it's not to say you can't just do fixed rate loans. You can, 2, 3, 4 years. Some land associations, we're very, very happy with those as well. But we tended to get a move towards RCFs.
Okay, thanks, Nick. We've actually had a couple of questions come in. We can pick up on those now. So do housing association investments comply with ESG policies?
Well, that's a good question. I suppose it depends what the ESG policy is. I couldn't give a straight answer to that. I mean, in terms of what the organisation does, in terms of the social aspect, you can't really fault it, really. In terms of the governance aspect as well, that they are regulated to provide excellent governance. So I'd say with the S and the G, I don't think you should have any problems there. The E I can't really answer, obviously environmental. I'm sure many housing associations are moving down that route as part of their business plans, but not something I can answer with any great confidence. But certainly, if you're looking for an investment that kind of meets the, meets local authorities, councillors' feelings about ethical investments and things like that, I don't think you can go really far wrong with an investment with a housing association.
Thank you. And we've had another one. Has a housing association ever gone bust?
Not to my knowledge, actually. That's not to say some weren't close to going bust, I think. But they had the regulator would get involved, would encourage, intervene and encourage mergers and things like that. So similar to the building society sector, maybe in that regard. I've been an advisor for a long time now, and it always used to be the building society sector, they'd always come and look after their own. And I think we've had we've had some of that as well in the housing association sector. So those that were feeling a bit more pinched financially, particularly during the austerity years, tending to look to the larger ones and go into partnerships with them. So no, I don't think a housing association has ever gone bust, leading to investor loss, which is part of why investor appetite is pretty strong for the sector.
Thanks, Nick. Can't see any other questions. So I think that's probably a good place to stop. So thanks very much. I certainly found that interesting. I hope our listeners did too. And so next week we have a presentation on ESG borrowing. So please tune in for that. Same time next week. And other than that, thank you very much for joining this morning, and we'll be happy to take any questions after as well.
Super, thanks very much.
Thanks.